All right, guys, in this video, we're going to talk about debt-to-income ratio, otherwise known as DTI. You'll hear us say that, a lot of these little acronyms. But debt-to-income basically is your income minus your expenses. But what we want to talk about first is what expenses actually count against your DTI and what expenses don't count against your DTI. So talk about the ones that do count first.
Car loans, credit cards, mortgage, student loans. Everybody has student loans. Child support.
Child support does actually show in there. I didn't write that on the board. Child support will show on your credit.
And if it doesn't show there, it's going to show on your pay stub if they take it out.
Yeah. So what we really mean when we look at things that qualify against your expenses, they are, or against your income, the expenses that qualify against your income, they are things that will show up on your credit report or as an account on your credit file. So your car payment, your student loan payment, your personal loan payment, your credit card balances, all that stuff is going to show on your credit report. What is not going to show will be things like your rent, your utility bills, your insurance, whether it's health insurance, life insurance, car insurance. None of that stuff shows on your credit report. Membership services.
Cell phone bills does not show up.
Cell phone bills, if you have a gym membership, I mean, there's some places that have like a $200 a month gym membership. Doesn't show.
We don't care.
Doesn't count. And daycare. Now, we know how expensive daycare can be. The good news is it doesn't show up on your credit report, so we don't have to worry about that. But Neil, let's break down. Let's just take a simple example of income. Let's just say somebody makes $4,000 a month.
Okay, let's say you make $4,000 a month. On an average, we can use 45% of that. In the old days, when I first started in this mortgage business, it was only 25%. Now remember, this is gross income. We know you're not coming home with $4,000, but we're basing it on gross. That you gross $4,000 a month, which is what? 4 times 4 is $48,000 a year. So we can use 45% of that on an average.
So 45% of that will be $1,800. Now, from that we have to subtract.
We have to minus car loans, personal loans, student loan, mortgage, and credit cards. We just did an average. We did a basic person, and it was $500 in bills, and they had $1,300 left. That means they can afford a $1,300 payment for a mortgage.
Now, what we mean by a $1,300 payment means the principal and interest, which you'll hear is PITI, principal, interest, taxes, and insurance. So when we calculate that payment, we're factoring in the mortgage itself, plus your homeowner's insurance, and plus your real estate taxes. So it's not just for the loan itself.
Plus mortgage insurance.
Yeah, and sometimes it's mortgage insurance if you don't put 20% down. Go ahead.
That's why I always say when people say, oh, I want to live in Delaware County or Montgomery County or Bucks, you don't realize the house might be maybe a little bit cheaper, but if your taxes are $8,000 a year, that's $700 just in your payment, just for your taxes. So you got to be careful. Philadelphia is cheap. Delaware, the state of Delaware, is real cheap.
Yeah, the taxes in Delaware are really good, and the value for the houses, you can get a lot more house for the same price in Delaware. You could buy a row house in Philadelphia, or you could buy a single family house in Delaware.
A big single for like $250.
Right. And the taxes are still cheap.
And the taxes might be $1,500 a year.
Now, obviously, guys, if you make a lot more money, this number becomes a lot higher, so you then qualify for a lot more. And if you want to look outside the city of Philadelphia, you'll be able to afford to do so. But we want to just give you a simple idea as to how to calculate that. Whatever your income is, let's just say if you make $60,000 a year, that's $5,000 a month. Okay? Just figure out whatever that number is, the $5,000, take that number and multiply it by 0.45. That's going to tell you what your actual income is that we use. From that income, we have to subtract car payments, student loan payment, personal loan payments, and credit cards. And when we say credit card payments, we mean the minimum monthly that shows up on your bill.
Yeah, not what you pay. You might pay more. You may pay $100 a month. If your minimum payment's $25, we only have to show.
Correct.
Student loans. You might say, hey, I pay nothing on them. Well, FHA guidelines is that we have to take the total student loan and take 1%. So if you owe $50,000 on student loans, that's a $500 a month payment. We know you're not paying it, but we have to live by guidelines.
And now that's another reason, going back to credit, why credit is so important, that if you have student loans, if you have a credit score of 620, we can do what's called a conventional loan, in which case you go on what's called an income-based repayment. Now that payment, let's say 1%, your payment may be $500, but on income-based repayment, you may only have to pay $100.
Or zero.
Or zero. But if it's $100, we only have to use that $100, not the $500, which is 1%. So that's another reason why credit comes into play and can be very beneficial to have a higher credit score. So that covers debt to income ratio, or otherwise known as DTI. Guys, play with that number yourself. Maybe right now you're just kind of kicking tires and you're like, what would I qualify for? Start playing with that number. Take your total gross income, multiply it by 0.45, subtract the expenses that we mentioned over here, and say, hey, okay, that's what my monthly payment would be.
And you might realize that your expenses are too high. That might affect you to start that budget.
Right. Then you might want to start implementing a budget. Now, one last thing I want to talk about, and this is something that a lot of our borrowers look at, and they say, okay, well, I may qualify for a $2,000 a month payment, but I don't want a $2,000 a month payment. Don't put yourself and be house poor, because you don't want to do that. Then you might regret buying a house, or you may strap yourself depending on how you are with your finances. But just remember this, if you buy a house and let's say your mortgage payment's $1,500 today, it's going to be $1,500 for the next 30 years, assuming that your income's going to go up. Now your taxes and your insurance may go up, which may cause the payment to go up slightly, but at the end of the day, you should be making a lot more money over the course of the next 5 to 10 years, so your payment's not going to change. Your rent, however, is going to change every single month.
Yeah, your landlord's going to raise the rent.
Right, so the landlord's going to raise the rent every single month. And how many people that we have call us, they call us and they say, well, for the last 10 years, it keeps going up. If I would have bought a house and had a steady mortgage, I wouldn't have this problem. So that's another reason why if you're looking at this and you're calculating all this stuff, and you figure out how much you're renting, you may say, it makes a lot more sense to buy a house. Yep. So hope you guys found that helpful. That's it for this video. We'll catch up with you guys in the next one.
Thank you.